Good morning and welcome to Bazaar ki Baat. Besides our regular market update, today we are going to continue our discussion on factor investing, especially from the Indian context, and also touch upon whether gold investing makes sense in our investing context. But before we begin, we would like to highlight that none of our discussion today is from a perspective of giving any recommendation. It is purely for spreading financial education. Welcome, Kshitij and Vikas. Good morning and wish you a very happy Diwali in advance.
Happy Diwali, Shruti. Happy Diwali to everyone.
Hi, Shruti. Happy Diwali.
All right. So, after a raging bull market in the Indian equities, we saw that equities dropped in October. We saw 6 continuous days of Nifty correction. And from my interaction with investors, it was almost palpable that we had stepped into a longish kind of a correction phase. What is your take on this, Kshitij?
No, I would say it's a minor correction, after a raging bull market, and this was largely expected. From last year, if you see the charts, you will see we are still in a bigger uptrend. We are not far off from the upward trending line. The fall has resulted only us being one standard deviation away from the mean of a large uptrend in both Nifty and Nifty mid cap. So I don't think there's so much to worry. Largely, this fall, there is so much uncertainty around the world, right? So there was a fall expected somewhere down the line. This happened currently. Largely, you can see we had the recent conflict from Israel and Hamas in the Middle East, which spooked the markets. Specifically from India perspective, what is important is the oil prices, which we need to keep an eye on. If that goes out of hand, probably we might there may be a situation of worry. Also, this conflict is not just about a regional conflict. This may actually become bigger with if the bigger players like US and Iran and other countries get put into it. From global perspective, I think the biggest worry still continues to be the hawkishness of central banks. And because the inflation in the larger economies is not abating, so the central banks are continuing with their hawkish stance, be it Fed, be it BOE, even others, ECB. I think all of them have continued to be there on their hawkish stance, and which puts a pressure on the risk asset, any risk asset, and specifically for equity, it is a force which pulls it down. From an Indian indices perspective, I think one of the larger reasons we saw a drop in October is that we saw FPI selling in Indian equities, and which it is still continuing.
I think the global concerns are also showing up in some of the sectoral performances, right? Some of the IT companies have shown muted results. And Kshitij, we are also in the midst of earnings seasons. So how do you think are the corporate earnings really unfolding this time?
Yeah, so as you said, large cap have posted muted results. They are the first to come out with their results in any earnings season. And they posted quite muted results largely, and it was as anticipated, largely because we are seeing their user base is slowing down, right? Economies, especially US, we are seeing a slowdown in the economy. So that's been one of the reasons. Europe and US both are slowing down. FMCG companies, we saw margins got a boost. So decent bit of results in the bottom line due to lower raw material prices. But the top lines are not so encouraging because the volume growth is not coming due to rural demand not picking up. And this has continued for a while now. I think post-COVID, while the urban demand has come back, rural demand has failed to come back, and that has been a worry for a long time. We have to hope that rural demand comes back, and that probably will be a boost for a lot of companies focused on rural consumption. The bigger chunk of Nifty, the financial companies, they delivered robust numbers largely on account of stable asset quality trend, and also the spike in rates have actually been passed on in their advances, while the same is slowly being trickled into deposits, right? But the expectation is that NIMs will come under pressure as we move forward, and as the deposits get renewed and the cost of funds gets higher for banks, we will see some amount of pressure on the NIMs. Overall, I think the earnings season so far has been in line with market expectations. Just to give a perspective, out of the Nifty 50 companies, 41 companies for which results have been announced. 29 have shown positive profit growth. 9 have shown negative profit growth, and only 3 have neutral growth. So overall, it has been a positive set of growth. So we are still in a growth phase from a Nifty 50 constituents perspective. And that's been the expectation and the reason why equities in India demand commanding a premium over the long term. Yeah.
Right. Okay. So let us now move to our first special topic for the day. So if you
Yeah.
remember last month, we had introduced the concept of factor investing to you. And today we are going to look at factor investing more from the Indian context. So that you
Right.
were recently invited to conduct a workshop for quant investing held by the CFA India Society. And you spoke about factor investing in the Indian context. So how have factor indices really been doing in India?
Yeah, first of all, it was an amazing experience talking for almost 2 hours with the eager participants. Secondly, as I said, I think I covered a bit of all this in that workshop. So firstly, let's just dive in. So as we had discussed last time why how factors have done worldwide. So in India specifically, I just put out a data, and I think we are seeing that data on this screen. The 10-year in the last decade, how factors have done in India. We have taken S&P BSE factor indices as an indicator of our performance. They are a good, I would say, they are approximate measure of how factors have performed. If we see the size, momentum, quality, low volatility, all of them have outperformed the large cap index by a margin. So they all of them have done well. Low volatility, as I said last time, is a unique phenomena, and it became very popular post the GFC. Once people realized that risk adjusted returns is what should be the focus, and then suddenly the low volatility phenomena came into focus. Uh, Only if you see the chart, we see the value has underperformed meaningfully post GFC, and that has been a global phenomena. So if we would see the last decade for any country around the world, we would have seen value not doing so well. Value started doing well post the COVID recovery, right? Once the macroeconomic conditions improved, we saw value stocks doing very well. And now, if we see the chart, it has recovered its underperformance and still slightly above, ended up slightly above the large cap index. So overall, I think all the factors are doing well, and in India also, and specifically, if you see the chart, they it's not a straight line, right? They keep on moving up and down.
So it is evident that, I mean, we can see from the chart that these factors have the potential to outperform the benchmark, especially the large cap indices. But we don't see a lot of investors, really engaging in the same. I mean, when we talk to the investors, not many of them are talking about factor investing, factor indices. Why do you think that is the case?
So yeah, one is obviously it is still becoming popular in India, but this specifically why across the world and India it is not becoming very popular is that it's not a free lunch, right? So it's not like we can just run a factor investing and we will outperform the market. The key element of any factor strategy, or specifically the single factor strategy, is its cyclicity. And factor indices performance tends to have cycles. So what happens is that even if the factors outperform in the long term, for a person or an institutional investor specifically, there is job risk running a single factor indices, right? So once if we decide to run a single factor indices, there can be periods of large underperformance while the institution might not be able to sustain with it. Just to take an example, the one of the most selling fund managers in India, Mr. Prashant Jain, he had a value to his style in investing. I had a huge underperformance for over last decade when value was not doing so well. Once post COVID, the PSU stocks and the value stocks started doing well, he actually recovered. But during that phase, if he was not so had such a long-term track record behind it, any new other fund manager would have been forced to change his style, or either there will be job risk to his work. So that is the reason why it has not become popular in the institutional world when people are managing client money. Secondly, anecdotally, we know that for retail investors, the holding periods are not long, right? So they are actually worried too much about the short term and not focusing on the long term. So that has been the reason. And if you see the chart, right? So every year, the best performing factor has changed. Almost apart from a year, maybe in 2020 and 21, we saw the best performing sectors keep on changing, and they change sharply also, right? They can, from the best performing, they can go to the worst performing also, which actually puts for a retail investor may not be sustainable or may not be behaviorally possible to run that strategy. And that's the reason why this is not being arbitraged away. And there is that premium to factor investing.
Hmm. Hmm. Yeah, I think it's quite beautifully visible from the chart how individual factors have done so differently in different years. But
Yeah.
while this is true for individual factors, do you think that there is merit in combining two or more factors together? And is there potential to generate an alpha out of that?
Yeah, fair. So I see there are three ways any investor can run a factor investing strategy. As we said, just have one of the most straightforward is just to have a long-term horizon, right? So if you want a single factor strategy and you're keen to run it, just have a long-term horizon. And for institutional investors with extremely long-term horizons, like 15 years or so, probably there is a case for running single factor strategy. Secondly, you can have for explicitly timing factors, and if you have a mechanism where you can time factors, that is, I think, maybe a way to run it. Just shift from one factor to the other and time it beautifully. But there are studies and academic research you can really use for it, but it has proven challenging. And at least I don't know any strategy or people doing timing of factors very well. There are research which says you can use trend following with some success moving from one factor to another, but the study has not been replicated successfully so far. So the other way, or the most easiest way to improve factor performance, is that you reduce drawdowns and improve performance by combining factors, right? So basically, once you combine factors, what you are doing is you can diversify the risk to have a higher risk adjusted return, right? And why we are saying that? Because these factors have either low correlation with each other or negative correlation with each other, right? So that's the reason why you can run a multi-factor strategy, right?
Right. Okay. Hmm. I think that makes a lot of sense. While I was only thinking about combining factors together, I think what you said about trying to time, factors into the market due to various strategies, that's also an interesting proposition, although I can imagine why it's difficult to implement in the market. So I think great, Kshitij, thank you very much. I think this is extremely relevant in today's context. When we are constantly debating about whether we should be passive investors or active investors, is there potential to generate alpha consistently from the market and so on? I think factor investing does seem very interesting, and we might actually see a lot more happening there. So thank you so much for your insights.
Yeah, just to add here, as in we have at least internally, we have tried to different approaches to combination factors. And to some success, we have been running a value momentum strategy. So that's also there.
Right, right. We have been doing that, and I think that's the reason we wanted to bring out the aspect of combining factors as one of the easier ways to use factor investing to generate alpha from the markets.
Yeah.
Thank you. So let us now move to our next topic. Dhanteras is just around the corner. And I remember, while I was growing up, Dhanteras was really big in my family. It was all about, visiting stores and buying either physical gold or physical silver. But, today, when I look at the market, there are many other ways in which we can invest in, especially in gold, right? Do you want to take us through them and what are the respective merits individually?
Hi, Shruti. So actually, this I wanted to discuss gold because I am back at my home and I'm seeing a lot of people having inclination towards investing in gold or buying gold. There's so much of rush at gold stores. So I thought that this is a good time when we can discuss about gold and what are the like options through which we can invest in gold. So we all have been born brought up by seeing physical gold. Like we have seen our family members buying gold coins or jewelry, which are gold instruments. So this is one of the traditional ways in which we can like invest in gold. But as financialization of savings has happened, there are other avenues also through which you can take a similar kind of exposure to gold, and each one has their own merits and demerits. So I thought that let's discuss all the alternatives that we have. So one is physical gold, another is digital gold, gold ETF and gold mutual funds are another option, and the last and the most I think upcoming or the most interest area where the new money is flowing in is SGBs, which is sovereign gold bonds. So when we talk about physical gold, it has one important aspect that it does not have any sovereign risk also. So this is one thing that you have to understand when you're investing in physical gold, so that it has some inherent advantage that it is not linked to the country as well. So you are able to diversify, you're able to mitigate country specific risk also with investing in physical gold. Other than that, there are certain challenges that you have to face if you're investing in like physical. So like storage is a problem. And what happens is that whenever you're buying gold from a jeweler, there is an transaction charge. By this, what I mean is that there's a difference between a bid and a ask spread. So when you are going, you're buying at a higher rate, and when you want to sell, there is a like 4 to 5% kind of impact charges just in buying and selling. So this is a charge that you have to incur if you have to sell your gold. And another one is that you don't know what is the purity of the gold. So if you're buying, you have to ensure that you're buying from a trusted vendor and you can always sell it back to him only. So these are certain things that you have to be very, very clear when you're investing in gold via physical gold. Another thing is jewelry. So see, jewelry, what I would say is that it's a quasi investment in gold, but it's not a like pure play investing in gold. Jewelry, you can say that if you're buying gold jewelry, there is a certain amount of gold exposure that you are taking, but it is not an investment. It is more for your usage or your consumption. So it's an in expense, but yeah, it gives you a quasi investment kind of exposure. Another thing is digital gold. So this there are a lot of apps in the market which are promoting you to buy digital gold. But see again, this I personally do not like it because of the charges again. And you can get a similar kind of exposure digitally without paying charges. Like so this GST and all you can avoid if you invest in other alternatives if we discuss. The third one and the fourth one are these two instruments are where I also invest, and I see that there are use cases of both of them. One is gold ETF and gold mutual funds. This is a very easy process to take gold exposure. And the good part about gold ETF and gold mutual fund is that the redemption and investment is very quick. So if your gold investment is for a pure play asset allocation, by this what I mean is that you want to do a rebalancing every year or every 6 months, this is the best investment option because no other investment option will give you rebalance opportunities at so low transaction cost. The negative is that, yeah, there's some fund management charge that you have to pay. But if there's a use case, then this fund management charge is much lower than the other alternatives. And the fourth one, which is the most coveted, is sovereign gold bonds, which I think there's a lot of interest because you get an additional 2.5% interest. And another good thing about this sovereign gold bond is that the capital gains is exempt. So now what happens is this has having a higher use case because earlier in your debt funds, you were having indexation benefit. So if you hold it for more than 3 years, you can avoid tax. But now if you do an asset allocation via SGBs, and if say suppose this is your long-term allocation to alternative assets then equity, this will help you save tax also on your long-term allocation. So there is no other long-term allocation other than equity which can help you save tax. So how I advise people is that for your rebalance gold, you go to gold ETF and long-term allocation you take towards SGB so that you get the best of both the worlds. So these are the alternatives through which you can always invest in gold. Gold is a good asset class and we Indians have strong affinity towards it, so which is very well known.
Right, right. So, Vikas, for a very long time, we've been hearing that equity is the wealth creation asset. And, contrary to what my mother also believes, gold is not really worth investing in. What are the reasons that today you are saying that this is an asset class worth looking at. I mean,
Yeah.
are there any specific situational reasons which make it interesting to look at in today's context?
Yeah, so see, I have also been reading a lot of like economic learnings from the stalwarts like Warren Buffett or US, like the investors from US economy. They generally do not like gold much. They say that it's an unproductive asset and you are better off investing in equities. But I see that with India, there's one peculiar thing which is not in US. So we cannot compare the gold exposure of India to US because till now, at least till now, what happens is that we derive our gold prices from international markets, and gold appreciation is one way we see our value increase, and the another way is that currency depreciation is another aspect to gold investing which helps us generate return on gold investing. Since we are seeing that our currency is depreciating against US, this is a bigger trend which we are seeing in the last 10 20 years. So what happens is that if you see the last 5 6 years, gold on US dollar terms, it has not given any returns. But for Indian investors, there's a return because there's a currency appreciation. So we cannot just blindly follow what we are hearing from like other investors who are in international markets. So now by this, what I mean is that why I believe that gold is at a sweet spot is that last 6 years, the returns has been very, very muted. We are seeing a lot of geopolitical uncertainty. So there is already two wars which are going on. We are in the midst of Ukraine and Russia conflict. There's another Israel and Hamas, there's another conflict. So at these point of times, if suppose these kind of things escalate, what happens is that there can be economic uncertainty. And at these kind of economic uncertainty, gold has this characteristic of appreciating and it will protect your portfolio. So given and we also know that there's one more like Taiwan, China also is there, which can turn out anytime. So what I'm trying to say is that these kind of geopolitical events makes a good case for gold investing, and a lot of investors are equity heavy. So if you are equity heavy, this will definitely give you a cushion against one of the biggest risks that you have in your equity portfolio, which is geopolitical uncertainty. So this
Mhm.
is one of the bigger reasons because of which I think taking gold exposure right now is a good idea. Another one is that it has been muted like in the last five
Mm.
6 years on dollar currency terms. So if suppose if it like breaks out of this zone, we may see appreciation in gold prices overall. The third thing is
Right.
that we are also seeing that there are a lot of economies who are moving out of US dollar as a safe haven and their reserve currency. So there's some inherent demand for gold also that we are seeing. So these are some of the reasons because of which I think you can always have some gold exposure. And personally, see what I like, how I think about my asset allocation is that gold is the only asset class which can protect me from my equity risk. So the other debt as an asset class will give me some rebalance opportunities and all, but it may not protect me to a bigger extent. But gold has that characteristic that when the economy is not doing well, it may give you slightly better returns. So these are the reasons because of
Right.
which I think that you should always, but you have to always asset allocate. So you can have 10, 15, 20% of your exposure to gold depending on your goals and risk horizon.
Right. So I think it does make sense from an asset allocation perspective. And the various forms of gold investing has thrown a plethora of options in which people can actually take exposure. So I think that's an interesting takeaway for the festive season this time. Stay tuned for our next episode, and I hope this session was useful for you. Thank you so much.